this is our cash burden, essentially. We've talked about this one before. This is essentially the cash that the business is spending at a point in time that's going out the door towards the operation. So as an example, this cash burden includes, hey, what sales have we generated but not collected? It takes, any, retainage, accounts receivable, minus the bills that we have not paid. So all of our accounts payable, all of our credit cards and other liabilities. And when you net those two together, you're essentially saying, okay, we haven't paid these bills and we haven't collected this cash from customers. What is our net amount that is going out the door to fund the operations, net of all of that? And what that looks like for the business right now in October is about at the end of October, 139,000. That is basically working capital, like cash that's going towards the operations. So the reason that's important is just to know, hey, how capital intensive is the business at this point in time? Is there a lot of revenue we have not collected yet, and we don't really get good terms when we pay a vendor? That kind of helps us to gauge how much cash is being burnt right now in the operation side of things at the current point in time. So we've actually lowered the cash burden if you look from August, September. Now, the reason that's important is because obviously if we can keep our cash burden below our actual net profit, we can grow the business sustainably and not need any outside financing. That's why this is so important. So obviously, once we're able to fix up the net margin through the labor efficiency we just talked about in the last slide, and our cash burden is lower, we're able to grow the business without any outside capital, any owner's contributions, which is obviously the ideal way to grow the business, with the lowest amount of cash burden, with the highest amount of profitability. And so that kind of gives us an idealistic image of how we can grow sustainably.